Hey guys, it's Sasha. This morning, the stock market is having one of its worst days in recent history because the market is now afraid that the US economy is about to dive into a recession. The S&P 500 is down 2.4% today after already having a nightmare week last week. Tech stocks are selling off incredibly fast. Many are down 8 or 9% just today. And it's all coming on the back of news that the Atlanta Fed's GDP Now indicator is now predicting a big contraction in Q1 in the US economy. This model is historically very accurate, and the latest estimate is that in Q1 the US GDP will be down 2.4%. This estimate takes in all the different monthly release data points as they come in during the quarter and makes the assessment. And today's panic comes as this new report came out from Challenger, Gray and Christmas, which tracks the rate at which people are losing their jobs. And it says US-based employers announced 172,017 job cuts in February, the highest total for the month since 2009, when 186,350 job cuts were recorded. It is the highest monthly total since July 2020, when 262,649 jobs were announced. So February, the month with 10% fewer days than the other months, has just scored the highest number of layoffs since everyone was panicking, losing their marbles in 2020 at the start of the pandemic. February's total is a 245% increase from the 49,795 cuts announced 1 month prior. It is a 103% increase from the 84,638 cuts announced in the same month last year. Here you can see the chart, and just below the chart it says, so far this year, employers have announced 221,812 job cuts, the highest year-to-date total since 2009, when 428,099 job cuts were planned. And 2009 was the back end of the financial crash, the biggest stock market crash in recent history, so it sounds like the economy is seeing big problems. We already knew that there were issues bubbling just below the surface because many data points in the last 2 years, maybe year and a half, were indicating that the problems that the real economy is facing are being masked, being covered up by this tech surge on the back of AI. On the one hand, you have real businesses there struggling, having a hard time, high interest rates are punishing, low consumer confidence, and on the other hand, you have tech companies spending hundreds of billions of dollars to build out the biggest AI data center, to make the biggest AI large language models, and that effect was really making the average look all right. After the massive issues with announcing tariffs, then going back on those tariffs, then announcing the tariffs again with slightly different amounts, then cutting back on a lot of those secondary tariffs again, a lot of people last week were asking for greater clarity on the tariff situation.
They always say that we want clarity. Look, our country's been ripped off for many decades. For many, many decades, and we're not going to be ripped off anymore.
So Donald Trump doesn't seem to care how this approach is affecting US businesses. And then on the plane back to the White House, Trump also suggested that the market having a downturn would actually be a good thing. He said that it would push interest rates down, which would mean that businesses can then borrow again and stimulate the economy. I mean, technically that would happen, but you would first have to crash the economy to get there. And he said that the United States is going to make so much money from tariffs that they won't know how to spend it. Trump said that prices might also be going up in the short term. That's also part of his plan. So far, that hasn't really happened yet. We are very early, but nobody at the moment even knows what's happening with tariffs. The situation seems to change every day. And the consensus estimate is that the February inflation data will stay flat at 2.9%. That'll be the first full month of Donald Trump's presidency. The inflation data will be coming out on Wednesday. I will be covering it here on the channel. Make sure that you come back to watch that. If you want a deeper discussion than a YouTube video about all of this and to ask questions, I will be getting into the weeds of all of this with my course members on Thursday in our live session. Remember, my course is on sale at the moment. Use the code SPRING2025 at the checkout to get 10% off. The course teaches all the fundamentals of how to invest in stocks, how to do analysis, how to build valuation models, all of that stuff. The 10% discount expires at the end of this week. Go and get your discount. Link in the description and in the pinned comment. A growing proportion of the US economy in recent years has been reliant on other countries. Because US companies have been doing so well, the biggest companies in the United States are tech companies, like Google, Apple, and Microsoft, and those companies rely on sales all over the world. And even a really small dip in consumer preference, in attitudes, in other economies performing in other parts of the world can have a very noticeable impact on the performance of these companies overall. And over the weekend, the US government has been busy on continuing to build great relationships with other countries. First, Elon Musk replied to a tweet by Radoslav Sikorski, Poland's finance minister, where he said that Poland is paying about $50 million per year for Starlinks in Ukraine. Elon replied saying, "Be quiet, small man. You pay a tiny fraction of the cost, and there is no substitute for Starlink." Now, I don't know about you, but this is a very weird way to talk to any other person, let alone a senior member of the government of an allied country, the government of a country that actually spends even more as a proportion of their GDP on defense than the United States. Then Marco Rubio weighed in saying Poland should say thank you. This seems to be a very popular thing. Say thank you! Because without Starlink, Ukraine would have lost this war long ago and Russians would be on the border with Poland right now. Without wading into the mud of politics, this all sounds like the sort of argument that 4-year-olds would have at the playground, challenging somebody to one-on-one physical combat to solve a complex geopolitical issue. And the problem is that the world is a lot more complex and a lot more sophisticated than some of the commentators in the United States currently think. Producers of technology use parts, processes, innovation from China, from Taiwan, from the Netherlands, many other countries. Fertilizers and chemicals needed for food production come from all over the shop, from Canada, from South America, from Central Asia in some parts. Lithium needed for batteries in electric cars comes from Australia, Africa, and South America. Isolationism and calling everybody else an idiot can be popular with the masses. It's the strong man approach, right? But the economy doesn't give a shit about popularity contests. And if you are an exporter in another country, you now have a big issue where trade with the United States is suddenly a lot less certain. It's way more unpredictable. You could be having to pay huge tariffs. Well, your customers would, but that would mean that the product will not sell. So if you can prioritize other channels, maybe other markets, maybe selling more stuff, to China, Japan, the EU, maybe even Russia, I don't know, you would probably take it. The US market is huge, right? It is the dominant global economy. That is true, but the economy of the rest of the world combined is still 3 times the size. There is plenty out there, and I am not really sure that alienating one country after another by calling names and just being really childish and being extremely arrogant is really helping anything much at all. Tesla dropped over 10% today because of the growing negative sentiment around the company. So Elon is not doing himself any favors either. Now the Atlanta Fed is projecting that the Q1 GDP growth is going to be negative, and that could be the kickstart to a recession. Whether that is going to happen or not, we'll have to wait and see. But the fact that it is now on the cards, the fact that it is now the probable outcome, is an issue in itself. Official unemployment data has not really moved that much so far, but the issue that is beginning to creep in is people that enter unemployment, people who start becoming unemployed, are then unable to go and find a job. The number of people who have been unemployed for over 5 weeks is now the highest it has been since February 2021, when everyone lost their jobs because of COVID. And you can see in the most recent data from the New York Fed that the number of credit cards being taken out in the US is suddenly spiking. People can't afford to make ends meet. At the same time, transition into 30+ delinquency is sitting at the highest level since the financial crash. Transition into delinquency means people missing their first credit card payment. And on this chart, you can see something like 12% of the total credit card balance is now 90+ days delinquent. This means that those people have missed at least 3 payments in a row. 12% of the total credit card balance in the United States is 3 payments down. This is now roughly at the same level as when the big job losses were happening in 2009, when the whole credit crunch happened. So there are a number of different data points, all suggesting it something may be brewing underneath the surface. And the market does not like it. It doesn't like uncertainty. It doesn't like negative data. If prices do start creeping up with inflation because of the tariffs, and if GDP growth does go negative, this downturn can very easily turn into a major crash as confidence evaporates. In terms of overall stock market valuations, the stock market is still very expensive. There are still many tech companies out there with insanely high valuations. Not quite as crazy as they were 3 weeks ago, but still completely freaking bonkers because people continue to overestimate the potential of essentially commoditized products and solutions that do relatively basic things, but it's all AI, bro. That is where we are at. The Schiller PE ratio is still sitting at 36 as of market close on Friday. That's still incredibly high. And Palantir is still a $180 billion company with annual revenues of less than $3 billion. This thing could keep on going for quite a long time yet. I know a lot of you are probably feeling the pain right now, right? Portfolios, everything is red. Seeing your portfolio die 5 or 6% in a day is not pretty. And if we hit the kind of recession where a lot of people start losing their jobs, and those people then cannot easily go and find new jobs, and demand drops off a cliff, the 2008-2009 sort of recession, things could get ugly. We're not even 10% down yet. People forget. People go and say, this is it. This is the worst it's ever going to get, right? We're not even 10% on the way down from the peak. And the bad kind of stock market crashes can go down 40 or 50. And I hear people beginning to ask the question, Sasha, are you waiting for a specific number, to go and start buying stocks? Is there a specific price on some company that you're waiting for? Well, the most difficult part of investing by far is the psychology. I was right here saying that I thought the market was incredibly overvalued before the whole thing blew up and began bleeding every day. I started talking about it right at the end of last year, even though it was a very, very unpopular thing to say. I got a whole load of hate, a whole load of people taking the piss out of me. And just because stocks were horrifically overvalued then, but have now dropped, 10%, 20% in price, hasn't really changed that much yet. Just because something that was really expensive is not quite as expensive doesn't make it cheap. Let's see what the economic data coming out this week says. I'm going to be covering it here. Remember, go and get your 10% discount off the Investor Playbook course before it runs out on Sunday night. Thank you so much for watching, and I'll see you later.